What's going on in the world economy? I'm Marco Perry. Welcome to the Perry Platform. If you've glanced at the news in the past couple days, or maybe even weeks, you're probably aware of the fact that the world economy isn't doing so hot right now. If you log into your investment accounts, you'll likely see a massive loss for this year. Things are going south, and people are wondering, is there a recession looming? Will things get worse? Are we at risk of facing a situation similar to what happened in 2008? Based on timing, it seems about appropriate, but let's dig a little bit deeper into what's causing these issues. So, this past Monday, the Canadian stock markets experienced their greatest one-day drop since 1987. At its peak, stocks were down as much as 10% and the exchange closed around that. It was a bad day for investors. People are looking at their portfolios, if they have them, and they're beginning to sweat a little bit. Panic is definitely playing a role in the sell-off that we are witnessing. Users of these financial institutions are flocking to things like bonds. Bonds are essentially a guaranteed investment. You give a certain amount of money to the government, for example, they tell you, we'll pay you back the principal, that is whatever you gave them, plus there will be periodic interest payments. Maybe you'll give them $1,000 for 10 years, and you'll receive 1% interest every year from that. Bonds are some of the safest financial instruments that you can hold in your portfolio because if something like the government cannot pay you back, you're likely facing far greater worries than how much investment return you're going to get in that given year. It's probable that you are in the midst of a civil war or the government has collapsed and anarchy is stemming out around you. So, in return for that security, the returns are typically lower, like 1 to 2%. People are okay with that now, given this context though, because it seems like if you're in the stock market, you're going to do a lot worse than that. You're going to hit a negative return, something to the tune of 7 to 10% in the past couple days. As people make this transition, they sell off their stocks and try to buy bonds. By selling the stocks, they're driving the prices down, and by increasing demand for bonds, those are going up. And you can see that in our market. There's also a very interesting trend going on. Long-term yields are becoming cheaper than short-term ones, and what that basically means is that if you lock into something like a 25-year bond agreement with the government, you'll typically want more money than if you locked into a 10-year one, because your money's with the government for a longer amount of time, therefore you want more money for that period. But the trend has begun to inverse, and it's been doing this for a while actually. People are willing to accept less money for a longer term. Why would they do that? The answer is they are afraid. If you think the interest rates are going to tank further, if the market's going to cripple itself in the impending future, then you might be okay with locking in a lower rate to make sure you're covered for a longer period of time. If you feel like a 5-year bond is not going to get you through a recession and you're going to have to renew it when times are rough, that might not be appealing to you. You might say, hey, give me the lower rate, but give me 10 years or 15 or 20. When a pattern like this occurs, where the yield curve essentially inverts and longer ones are cheaper than shorter ones, it's a bad signal to the market. It means that investors are losing confidence and they want to be safe right now. People are going to see that and they're going to be influenced to follow suit. More people will sell off of their equities and they'll flock to things that are safer, like bonds and maybe even gold. It's kind of like a cycle. It's going to feed off of itself. And now let's say you didn't do that and you stuck with your equities. If you broadly invested in the TSX, for example, your investments would be down about 10% this week, which may or may not be that substantial, depending on your status. If you only invested $1,000, you'd be out $100. That's not going to make or break your world. But if you had a portfolio of $100,000 and now you're out $10,000, that could be a little bit more serious. And if you had $1 million and now you're out $100,000, well, that could make you sweat a little bit more. It all comes down to how you've invested and how big your nest is. This is the power of percentages, and it's actually quite interesting. If you've only saved up $10,000, 10% of that isn't really that good. But if somehow you manage to accumulate $1 million and you have an investment that's paying you 10% yearly, you can just live off that $100,000 and forget that. Let's just say you're earning 5% somehow through a dividend from a company. You can get that. A lot of Canadian banks right now have their dividend yield around 5%. If you have that $1 million nest and you're earning 5% in dividends, you're making $50,000 a year off that. That's like a salary. You can just stop working. It's such a powerful tool, but I digress. So, now we get to the question, why is this happening? Why are the markets tanking? Why are investors fleeing to bonds? Coronavirus fears are playing a major role in this. Global supply lines are being disrupted. Manufacturing is being halted as people enter self-quarantine isolation, and countries are spending their attention trying to curb the spread, not focusing on things like economic expansion. People are also not going out, and therefore not spending as much money. Tourism is also tanking, and that's been a major detriment to many economies. First of all, the airlines aren't making money, the local tourist spots aren't making as much money, vacations are being canceled, so the resorts aren't making as much money. Overall, it's been a net negative, and growth in Canada is currently estimated to be below 1%. So, there's the proof that not much economic activity is projected to occur this year. Now, as of late, there is a second factor that entered the equation and is playing a role in these massive drops that we are seeing. There is a brewing oil war between Russia and Saudi Arabia. We had the trade war, and now here's part 2, the oil wars. These are two of the largest oil producers in the world. According to Vox, conflict started between them when it became clear that demand for oil had dropped in the world. People aren't moving around as much due to the coronavirus, via plane or car or whatever, and thus you need less fuel. Saudi Arabia suggested that members of the Organization for Petroleum Exporting Countries should cut production. That's basically a group of countries who sell a lot of oil. Russia isn't a member of that organization per se, but Russia still coordinates with them. They work together. So Russia was being asked to make the largest cut of anyone at around 500,000 barrels per day. Mid-Monday, the price per oil barrel was around $33, so even with the massive fall that we witnessed, 500,000 barrels is the equivalent of $16.5 million per day. It's not like Saudi Arabia was asking for a chump change here, and the basic idea is that if we cut supply to match the falling demand, prices won't tank as hard. If we have an excess and competition starts to get ripe, well, things are going to be bad for all of us. Russia, you might have to pick up the slack a little bit because your economy is fairly diversified. You'll be okay if oil does tank, but other countries, we will likely be crippled, and that's all we have. So, can you help us? Russia said, nah, we are not interested. So some speculators say that Russia actually wanted the price to drop because they knew it would hurt the American economy, but that sounds like a kamikaze type tactic to me. Russia also loses money because they export a lot of oil. When oil drops, they get hurt too. Do they really hate America that much? Maybe, but who knows? We don't understand the exact rationale just yet. It's possible too that they just didn't want to dial back production that much. They're being asked to lose millions of dollars every day. Market share is at risk here, and losing that willingly to other countries isn't super appealing when the benefits aren't clearly articulated to Russia. What did they gain? Russia likely figured that they were better off just competing against Saudi and co. Saudi Arabia, in return, was pissed off by that. They didn't like the lack of cooperation, and what they did was they slashed their oil prices. It was the biggest one-day drop in oil since 1991. As you can see here, lots of records were being broken on Monday. This message effectively tells Russia, you want to play hardball? Good luck making money in this market. We're going to crash it for you. Saudi now stands to earn tremendous market share given their low prices. Everyone's going to be buying oil from them. Even if it comes at a loss to Saudi, they're okay with that. Now, keep in mind, Saudi Arabia and Russia aren't the only two players here. Countries like Canada export oil too. When Saudi is running around tanking prices, that's going to impact numerous world economies. This compounded the stock market drops that we saw. You have two choices here now if you want to compete in the global oil markets. You match Saudi Arabia's price, which is extremely low. That might not be enough to make profit for you. Or you just stop selling because you're being heavily outcompeted. A province like Alberta is set to face the greatest impact, and they might be staring down the barrel of major uncertainty. They might be looking at getting hit extremely hard due to this. Having a non-diversified economy that's heavily reliant on oil is risky in a global playing field, especially when you have these giants like Saudi Arabia and Russia who are playing willy-nilly with the price. Now, what do? We really have to wait and see how things play out, who's going to blink first. Does Saudi realize that their margins are too low and then they pump the prices back up? Does Russia go Rambo and drop prices even further to fight back? Does America come in and impose sanctions to force the countries back into line? Or do we just ride the train for now? One thing's for sure, the longer these factors of coronavirus, number one, and the oil wars, number two, continue, the further our markets will drop. Now we get into countermeasures. How can we fight these drops? Should we fight these drops? What is Canada thinking about doing? The Bank of Canada is seriously considering lowering interest rates again. Right now it's at 1.25%, but talks are dropping it a further 0.5% are in the air, bringing it down to 0.75% for the foreseeable future. Now, what are the benefits of a lower interest rate, you might be wondering? First of all, it's going to get people to spend more money on major things. That's really what the government's trying to do here. If they lower interest rates, you might be inclined to do something like buy a car, buy a house, invest in something because it's cheaper for you. If you're paying a 5% interest rate, that's an extra 5% of costs you have to factor in to your budget. If the interest rate is near zero, as it will be with this change, well, it's just cheaper for you. The car is not as expensive, the house is less expensive, it's more affordable. They want to jog the economy, artificially I might add, by bringing these rates so low that you have a high inclination to spend money. The aim here is that by doing that, more money circulates through the economy, things pick back up, people are buying things, people are just becoming active members again, and therefore things are going to get better. Now, that brings up the second part of the question though, and that is, well, if it comes with all these benefits, why don't we just put the interest rate at 0% all the time? The truth is there are negatives that come with reducing your interest rate. First of all, you induce inflation. To what degree, we can't tell. It depends on how people respond to the cut and how much buying they do. In Canada, where housing is already extremely expensive, where people are priced out of major cities and they can't afford to live there anymore, you really want to reduce interest rates and incentivize people to buy more housing? When you do that in combination with things like the first-time home buyer incentive, it's the same amount of assets here. Canada isn't building more houses. Well, not more than they were doing before. Demand is going to grow at the same steady rate, but you have pumped up, I have that backwards actually. Supply is going to be growing at the same steady rate, but demand has been pumped up artificially. It's the same amount of houses here, but there are people with deeper pockets now. If everyone can afford to get a lower interest rate now by about 0.5 basis points, the prices are going to go up accordingly because you're all bidding for these same resources, but you all have more money. For the first-time home buyer incentive, the same logic applies. We have to ask ourselves, do we really want this to happen? Do we want to make money more readily available when it's not entirely clear that we are entering a recession just yet? And at the same time, the more you lower interest rates, the less effective the decrease becomes. For example, if you have the interest rate set at about 5% and a disaster occurs where you do really need the economy to pick up, you can lower that rate by about 2%. People will see that and be like, oh, that's a major savings. Yeah, we should definitely get into the market now. But when your interest rate is only 1.25%, how much room do you really have? For that interest rate to drop to 1% or 0.75%, people will see that and be like, yeah, it's a savings, but it's a minor one. This is what happens when you abuse the interest rates. The effect begins to diminish. And eventually, if you don't ramp it back up, you find yourself in a situation like we're getting close to where you have very little wiggle room now to negotiate. If people are still not buying things at 0.75%, what do? Do you go to zero, where the banks are giving out free money basically? Or do you go beyond that, like some countries have where you have a negative interest rate? In a context like that, the bank pays you to borrow money. That's a highly sketchy idea because it comes with so many opportunities to backfire. First of all, when a bank is paying you to borrow money, do you really think you're going to get your intended consequence? Remember, the only reason why we're playing with the interest rates is because we want people to buy more things, want them to spend more money and to jog the economy. But if you tell me that the bank will loan me money and pay me for taking it, I might just take that money and not buy anything. If I don't have to make a purchase, I'll take that money and stuff it under my mattress for a couple years and rack up the free interest. Then the bank loses money, paying interest to someone who's not spending anything, and at the same time, you don't even know if you're achieving your intended outcome because there is no incentive there. If I am paying interest to you to borrow money, I will not borrow money for no reason. But if you pay me to borrow money, I very well may do that. Then you might say, oh, well, the government can institute policies to make sure you really are spending it. And I'll respond, good luck with that. There are so many ways to fool the government and work around the system to make it seem like you've used the money while you're just shoving it under your mattress, for example. Now, on top of that, there's also a secondary risk when you enter these negative interest rate territories, and that is a run on the bank. When the bank is paying you money to borrow money, they're depleting their cash reserves. If people lose faith in the bank, if they say these practices are not sustainable, they make no sense, we want our money out now because we don't believe the bank is going to be able to pay us back in the future, and everyone goes to the bank to collect, that's game over. Because you must know, when you deposit your money into the bank doesn't keep it in a vault. They loan the money out to other customers and they make money off that. They might pay you a small fee of sub 1% interest, and they're going to charge somebody 2 or 3 to loan that same money. They're going to keep that profit and therefore be able to operate. Your money isn't really in their vault. If everyone goes to the bank today and says, give us our money, you won't get it because a lot of it's out right now in the form of loans and investments. The banks rely on you to not panic to ensure their business model is sustainable. If people panic because they see you giving out money hand over fist to people, that might be the cause of a major financial meltdown in our country. I'm not convinced as to the benefits of a negative interest rate, and it seems like we're getting closer and closer to it. Now, here's the question. Should we still lower interest rates? In this case, maybe. We don't know for sure. If there is a massive recession coming, the lowered interest rate and therefore the higher spending could do something to cushion that. It could hurt Canadians less if the economy doesn't fall by a major scope. There are valid circumstances in which you should actually lower the interest rate. 2008 was an example. But we don't really know if we're in recession territory just yet. And at the same time, we have to understand how these policies are intended versus what happens here. When the interest rate gets lowered, it usually does not go back up, and that's a major mistake. What the government should be doing is, during good times when we don't need more inflation, when we don't need more spending, the interest rate should be going back up, closer to that 5% threshold as it was before. When times are rough, then we will lower it to balance it out. We try to equalize the distance between the gaps here, but thus far, the government and investors have been very short-sighted. They just want lower interest rates all the time. That's one reason why housing has inflated massively. That's one reason why right now we have very little wiggle room, and it's not a good policy. We have to be willing to adjust, so I would say if we lower rates right now, there better be a plan for when things pick up again to bring it back up. We can't simply go on with a 0.75% interest rate without running the risk of entering negative territory in the next downturn. To me, the best way to view these interest cuts is essentially a stimulus, maybe a steroid. You don't want to be addicted to it. And maybe there are certain uses where it could benefit you tremendously, but to use it all the time and to get hooked to this artificial way of propping up the economy isn't good for anybody. Because when the serious hard times come and these steroids are not effective anymore, you're going to be screwed. So now just my predictions before we close off for today. It seems to me that the economy is going to be heavily tied to the coronavirus and the oil price wars for the foreseeable future. If one of those things eases up, the economy will likely pick back up, I would say at a rather rapid rate, because those two things are the major constraints right now. Getting rid of one of them will do good for all of us. Getting rid of both of them, that'll do amazingly as well. But conversely, if the coronavirus gets worse, and don't be fooled, there are lots of ways for that to happen. Right now, we're at a point where things could get really, really bad, or we can contain it and do okay. If things get really, really bad, the markets, I would say, are finished. People will not be spending money, you'll be staying home, and this year will effectively be a write-off. Then, the oil wars. Countries whose economies are heavily tied to that are going to suffer. Russia, I don't see shaking hands with Saudi over this in the near future. Saudi might have to be the one to raise their prices because right now they're playing hardball. Russia wasn't cool with their idea. Saudi got pissed, and now Saudi's wreaking havoc on the oil markets in response to that. If anything, this is further proof as to why we should diversify away from oil, because we have some, I would say, some pretty crooked regimes out there who are pulling the strings: Saudi Arabia and Russia. We don't want to be at the mercy of them every time they have a hissy fit over what they want to do with the oil prices, how they want to fix it this particular quarter. Now, if you're an investor, I'm not too sure how the markets are going to turn out in the future, and nobody really does, but it's almost always a bad idea to panic sell, to be heavily emotional in response to the markets. Things will pick up again one day. And if they don't, then this is the least of your worries. It means there's something fundamentally wrong with the economy and further capitalism, and therefore society won't be looking too hot. So if you have money in the market right now and you don't need the capital at this immediate period, just leave it. Just relax a little bit, maybe put some more money in to buy at the dips, and see what happens in the future. There really isn't any reason to panic just yet. So that now brings me to the end of our conversation for today. If you enjoyed the content, be sure to leave a review and share. They'll help us grow. And you can also find me on Twitter and Instagram at Perry Platform. Thanks for joining me, and I'll see you soon.